Well, when you look back over the last decade, investors have been yield starved. And so as rates are rising in here and the yield curve's flattening, actually it's creating a great opportunity for investors. The lemons part of it is the rise in rates, lower bond prices. The lemonade part is investors are going to earn higher yields for a longer period of time.
Well, only if they buy at the end of the process of rising yields. So I guess the key question is, when do we reach the peak of that process?
So for most investors, trying to time interest rates is the fool's game. It's really difficult to get that decision right, and generally investors don't go back the other way. And so we recommend that investors pick where along the duration or the risk spectrum it best meets their objective, stay there, and then allow professional investors to help maximize return for a given level of risk.
We talk about this wall of worry that seems to be growing right now for the markets. What's keeping you up at night?
Well, there's plenty of things to worry about. The trade tensions, a global event, certainly all of those things. But you look at it and you look at the U.S. economy, and we are soon to have, or at least tie for the longest expansion post-World War II. We're within months of that happening. We've got still pretty good fundamentals in the U.S. There is a divergence with growth weakening throughout most of the rest of the world. But we still have an economy that we think is chugging along at a pretty good momentum, where job creation has been robust, and for most individuals, things are clearly better.
What is your view on rates in the rest of the world, particularly the developed rest of the world?
Yeah, and it's a great point, because you look at the U.S. interest rates, and while we were just debating, are they going higher, they are the highest, some of the highest throughout the world. And you look at Germany, you look at Switzerland, you look at many of the developed markets, and interest rates are very low. They're, sub 1%. In fact, low single digit kind of nominal yields. So the U.S. is very attractive globally, and will continue to, we look at a world that's been yield starved, continue to draw in capital as rates rise.
Do you think there could be a day of reckoning coming for the corporate bond market, in the sense that we have seen a burgeoning amount of BBB rated debt? And if we do start to see some economic softening, if we do see rates rising, maybe some of that tips over?
Some of it may, and we don't want to be Pollyannish, but actually we think corporate America has been quite astute in this last cycle, and they raised a fair amount of debt, most of it behind a lot of M&A transactions, and they issued a lot of low coupon, low interest rate debt. They termed out their average maturities, and so they're in pretty good shape actually right now. One big borrower that we haven't talked about is the federal government, which did not term out their debt and faces a fairly significant reinvestment risk as rates have risen in here. So to answer your direct question, no, we are not worried. In fact, we look fundamentally, and we think there's a lot of reasons to continue to be constructive. That said, we are investing in a really well-diversified portfolio and taking advantage of many of those situations.